Welcome to the Greener Way podcast, a show about people, planet, and purpose, and how investors and corporate leaders push forward in a complex world. For this conversation, we're joined by Metrics Investment Director of Sustainable Finance, Alison Chan. Alison has packed a lot of career experience into a short amount of time, and we're going to talk about the state of sustainable finance in Australia, as well as its future and how Alison got here. So Alison, welcome to the Greener Way. Can you introduce yourself and tell us a little bit about how you went from being a lawyer to being an expert in sustainable finance?
Sure, of course. Thanks, Rachel, for inviting me to the Greener Way. It's really exciting to be making my podcast debut with you. I became a climate quitter in 2017, long before I even knew what that was. After almost 2 decades as a banking and finance lawyer, I took a sabbatical and I joined the board of a charity that was fighting food poverty. In those days, I learned a lot about inequality, food waste, and the role of policy and philanthropy on making people's lives better. And from there, I started to think about impact finance, but I was enjoying my newfound freedom and I wasn't eager to get back into the workforce straight away. I was living in London at the time, and one day I saw that as part of Climate Week, the Lord Mayor was hosting a day-long event, and I went along. It was on sustainable finance. Sustainable finance was new to me, but it sounded interesting. Sean Kidney, the Chief Executive of Climate Bonds Initiative, gave the opening keynote and he blew me away. It's hard to believe now because we hear about climate in the news every day, but back in 2017, I am ashamed to say that I didn't realise that we were on the precipice of climate catastrophe.
I don't think we should say ashamed. I mean, that's we're all in a learning process. And I think if we're sort of, it's progress, not perfection here. But it's an interesting point, sort of 2 years after the Paris Agreement, we were still really, really struggling with implementation and finding some of these solutions. And, the idea of sustainable finance did sort of seem like an oxymoron, didn't it, Alison?
Yeah, absolutely. Even though I was in banking and finance where, sustainability is such a big thing today, back in 2017, at least in the UK, it was all Brexit and Me Too taking up the column inches. So that conference was a real turning point in my career and I guess also in my life because I ended up taking a role in the sustainable finance team of one of the Australian domestic banks and moved back home.
And what was that like at that point? Moving from London, which at that point, looking from this side of the world, was sort of shooting ahead on sustainability, to come back to, a place where we didn't have policy certainty around climate, to say the very least.
Yeah, I mean, maybe that was a good thing for me because I sort of got to grow with the market, and I was really lucky that the role that I had allowed me to cover the European borrowers. And so I got to keep up with what was going on in Europe and still do, because as you say, Europe's leading and we need to ensure that sort of interoperability between what we do here and what we do there. And I think my legal background certainly helped with making that transition and taking the building blocks of the green and social principles and applying them to new products like derivatives or securitizations was really enjoyable, and I'm really pleased to have been sort of at the beginning of that process.
That's one of the things that's really fascinated me, that, as the idea of sustainable finance has evolved, the reach that it's had into different financial products, beyond, sort of corporate finance or bonds, into mortgages, into things like securitization and derivatives. It's neat to, sort of get to be able to discuss these things and be able to say, oh, look, there is a relationship between, a future contract and the ESG implications of the company that's on the other side of a transaction.
Yeah, absolutely. I mean, my current role is not so transaction focused. My team leads the sustainability efforts across the full spectrum of Metrics activities, our activities with our investee companies, but also with our investors, our member organisations, and what we're doing within the firm. Pleased to say we've got a very capable internal legal team who takes an active interest in sustainable finance. And I work closely with them in the areas where sustainable finance and the law converge. And, that could be things like executing the label transactions or sustainability reporting, disclosure, or regulation. And if those worlds collide much further, I might soon be renewing my practicing certificate.
I was going to say that, given greenwashing investigations and the level of interaction around compliance and legal, you're probably at a nexus that you didn't think you'd ever be at.
Yeah, I thought I'd left the law well and truly behind, but it still keeps my interest.
Oh, it's another string in the bow. So let's talk a little bit about how you integrate sustainability in private debt and in corporate lending, Alison. So sort of building on where you were when you and I first started talking together to your new role at Metrics.
Sure. So, ESG integration is a ticket to play in the local market. Australian asset owners require integration much more than their global peers. And just to recap, RIA defines ESG integration as the systematic and explicit inclusion of E, S, and G factors, environmental, social, governance factors, into the investment decision-making process. So ESG focuses on measurable risk and return on a set of defined material factors. And Metrics always integrated ESG in its investment decision-making process, starting with due diligence and then leveraging our private market relationships with the entities in which we invest to manage the ESG risks during the negotiation and documentation stage. But what we understand is that ESG is not enough anymore, and the partners have asked me to help identify and implement the actions that we need to take to lead by example on sustainability. And the difference between ESG and sustainability is often blurred, but we assess the two separately. Sustainability is harder to quantify because it's necessarily forward-looking. We're assessing the ability of the organisations to anticipate and adapt to a variety of long-term disruptions. So over the last 2 years, we've expanded our focus from that traditional lens that looks at the financial material ESG risks impacting on our investments to the more modern double materiality approach that also looks at the impact our investments have on the world at large. And we do that in a number of ways. We've developed and delivered industry-specific ESG and sustainability surveys that we have issued to each of our investee companies, and those surveys target the most material E, S, and G factors for the particular industry. And the questions that go to sustainability look at aspects like capabilities and embeddedness. Capability being the ability to recognise and assess the emerging trends and potential business disruptors for that industry, and embeddedness, the adaptability and agility of that firm to take advantage of the opportunities that are before it. So as the responses to those surveys come in, we're getting a lot of really valuable, detailed insights into how our investees approach their material issues and where there are gaps that can be plugged.
So as part of this process, Alison, what does this result in? Have you found that companies that are better capable of managing ESG risks and having strong sustainability practices are safer from a creditworthy perspective and therefore, have a slightly lower interest rate associated with the transactions that you negotiate with them?
Look, I think it's too soon to say whether improved sustainability is better credit risk. Certainly intuitively it is, but there's not necessarily the depth of data to be definitive about that. I mean, there's some research in the UK on green mortgages versus standard mortgages, which do indicate that there ought to be a pricing benefit. So, I don't think we have enough data to actuarially quantify that now, but we can certainly talk to borrowers about sustainability-linked loans and look at incentivising them and offering a reward for their efforts in reaching agreed sustainability targets.
So what does this actually mean then in terms of the decision-making process at Metrics, Alison? Are there some transactions that don't proceed because there's significant enough concerns over ESG risks? Are there preferences in terms of other parts of the transactional deal for companies that you find are managing those risks better?
Yeah, I mean, it probably wouldn't be a discussion about sustainability if we didn't touch on divestment. But very briefly, where a company's management demonstrates that is willing and able to adapt its strategy to mitigate ESG-related risk, we would prefer to continue to support them than to walk away. Having said that, we do have some negative screens and we have adopted a fossil fuel investment policy, and each of those serve as red lines for us. I mean, more than divestment, we would prefer to continue to engage with our borrowers. The conversations that we have off the back of those ESG surveys and of our due diligence are two-way discussions where we might have identified issues for periodic monitoring and will certainly raise issues as emerging risks as they arise. So we'll be learning more about our borrowers and their progress over time, and they will take the opportunity to learn from us about how they're going against their peers and in relation to international best practice. A lot of our borrowers are in the private world, and so they don't necessarily have dedicated sustainability teams, and so they find the information that they can get from us really valuable.
Oh, fantastic. Okay. Well, we're going to talk about what happens in Australia now that Australia has a legislative net zero target a little bit later. But first, I want to take a pause to tell our listeners about our inaugural ESG Power 50 list. We're in the final voting stage to identify the people who are working at ASX-listed companies that are kicking goals on environmental, social, and governance issues. And we'd like to put it out there to our audience. Certainly, we invite all of our guests, but I won't put you on the spot, Alison. But certainly, all of you listening to this podcast, we'd like you to have your say on our finalists list by going to www.fssustainability.com.au/ESG Power 50 and vote for who you think are the most influential ESG professionals in Australia. We'll drop the link to that voting list into our show notes for your convenience as well. And the ESG Power 50 list is brought to you by FS Sustainability with our gold sponsor Schroders and our silver sponsors AXA IM, Colonial First State, and ClearBridge Investments.
I've already lodged my votes in the FS Sustainability ESG Power list, Rachel.
We thank you for it, Alison. Back to it. How do institutions like Metrics work towards net zero, both as individual institutions and as part of collective groups? John Dunn from my high school English classes taught me that no man is an island. Is it the same for financial institutions?
Absolutely. It's both an individual sport and a team sport. The recent history of finance and climate is that it's a settled discussion that decarbonising the global economy is crucial for economic stability and financial returns. And now the focus has swung to how financial firms can make that happen. It's a shared question for firms in Australia, but also around the world. And reaching net zero is going to be a challenge, but the rewards are shared and they're huge. We joined the Net Zero Asset Managers Initiative, or NZAM, in 2021, and that's an international group of asset managers committed to aligning their investing with net zero emissions by 2050 and supporting the 1.5 degree goals of the Paris Agreement. As an NZAM signatory, we've got access to processes and tools that we can use to manage the decarbonisation of our portfolios. And publicly setting targets and tracking progress against those targets is part of that process. So last year, we measured our carbon footprint, both operational and financed emissions, and we set science-based targets. And you can find our targets both on our website and the NZAM website.
We'll drop some links to both Metrics and NZAM as well, just so our listeners have the ability to read along at home. Are you comfortable with that progress towards decarbonization? Because there's when you make commitments like that, it's the devil in the details.
Yeah, absolutely. But having a framework that sets out pathways for setting credible net zero targets and guidance on best practice for the kinds of policies that people should put in place on key issues like fossil fuel investment helps asset managers reduce the risk of unintended greenwashing. It also reduces the risk of green hushing, where an organisation might keep its targets quiet so that it can avoid accusations of greenwashing. And I think that's almost as bad. Because how can we assess the ambition of organisations and hold them to account if they're not making their targets public?
It also means they're not talking to journalists, which is always a problem for me personally. We're starting to draw to the close of our time, Alison. So I did want to get to this impact of now having a legislated net zero target in Australia. So just as we get close to time, can you explain to me what this does? Having a 43% reduction in emissions by 2030, how does that impact on lending and corporate debt activities?
Yeah, well, clear targets really help businesses and lenders understand the direction of travel and the pace of change and plan accordingly. Mark Carney talked about needing an energy transition on the scale of the Industrial Revolution at the speed of the digital transformation. And when financial institutions begin to model the disruption that will result from that, fast, massive transformation, and compare that against the strategies businesses have in place and their capability to adapt, it's going to become clear that some businesses will flourish and some will not survive. I think we'll see lenders applying increasingly levels of scrutiny of ESG and sustainability while they're deciding where to allocate their capital. And I think that the risk of, the time frame in which those risks might crystallize will become sooner, and therefore lenders will need more confidence that those risks are being properly managed now. And that will directly impact access to finance. The market's already showing signs that those that cannot or will not transition will increasingly find it difficult to access cost-effective capital. Now, on the other hand, the investments that are driving the transition are being rewarded with a greater selection of prospective lenders and sometimes consequent benefits on pricing and terms.
There's nothing like the fierce urgency now, to quote Dr. Martin Luther King Jr., when it comes to speeding up this transformation.
Absolutely. It's going to be an exciting time. Best we buckle up.
And on that, let's leave it there. Alison Chan, the Investment Director of Sustainable Finance at Metrics, thank you so much for your time.
Thanks, Rachel.
Thanks for listening to the Greener Way podcast. If you liked today's show, remember to rate and review us on your podcast platform and make sure you're subscribed so you don't miss an episode. Any feedback? Contact us on podcast@fssustainability.com.au. I'm Rachel Allen Backus.
The Greener Way podcast is a product of FS Sustainability, a show about people, the planet, and investing in our collective future. All information in this podcast is for education and entertainment purposes only. The Greener Way podcast gives listeners access to information and educational content provided by discussing numerous financial sustainable options and our featured guests. It is not intended as a substitute for professional, legal, or tax advice. The hosts of The Greener Way are not financial professionals and are not aware of your personal financial circumstances. FS Sustainability operates under an Australian Financial Service License and the exemption made available under the Corporations Act 2001 in respect to any information or advice given. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.